All right, we're continuing now on slide 25 of the Chapter 13 presentation, looking at horizontal analysis. We just finished looking at the balance sheet, and now they're providing an example of horizontal analysis for the income statement. And note the helpful hints that are shown here and in the text. For example, the 9.9% at the bottom is not the sum of the above percentages, but rather the percentage change in net income between the 2 years. However, the $99,000 bottom line change in amounts is the sum of the amounts, since net income is itself the combined sum of the above revenues and expenses. On slide 26, it's a fairly busy slide here, but the responses to this exercise are shown on the bottom of the slide and on page 696 of the text. Note how the percentage calculations are performed. The previous year balance is subtracted from the current year's balance and then divided by the previous year balance. On slide 27, vertical analysis, as the name implies, is a method of measuring the individual line items in an income statement as percentages of a base, such as total assets or net sales. On slide 28, when vertical analysis is applied, there is then a comparison made between years to see where significant changes, if any, have occurred. In the above example, the base amounts are total assets and total liabilities and stockholders' equity, since we're looking at a condensed and comparative balance sheet. That's why the percentages add to 100 at these instances. The text interpretation, as noted on the slide above, is that the company shifted toward equity financing by relying less on debt, as indicated by a decrease from 80.7% to 77.9%, and increasing the amount of retained earnings from 24.1% to 29.7%. This is true even though the absolute amount of liabilities increased from 2008 to 2009. You can see the discussion on page 697 of the text for more details about this. On slide 29, in this vertical analysis income statement example, net sales is the base upon which the percentages of each line item is computed. For instance, net income is 9.4% of net sales in 2009 and 9.1% of net sales in 2008. Since there are no major differences between years in this analysis for Chicago Cereal, another meaningful measure, as noted on page 698, is to compare with an industry competitor. And although the example competitor used, General Mills, is far bigger than Chicago Cereal, the percentages in the vertical analysis can still provide a meaningful comparison. As we go to slide 30, as shown here, the percentages show that although Chicago Cereal has a higher gross profit percentage than General Mills, 44 versus not quite 36, at the bottom line their percentages are almost equal. That's because Chicago Cereal's selling and admin expenses are 8% higher than General Mills. This simple analysis shows Chicago Cereal where it may need to focus its cost management actions. So that's the usefulness of doing this type of analysis. On slide 31, now we move to ratio analysis, which we have touched upon in a couple of previous chapters. So let's review the classifications: liquidity ratios for the measurement of short-term ability to pay obligations, solvency ratios for measuring the ability to survive over a long haul, and profitability ratios to measure the income or operating success of a company for a given period. On slide 32, here's a summary of the liquidity ratios. These have all been covered before in previous chapters, and we'll go through them again one by one. On slide 33, this vignette shows the potential volatility of the current ratio and why it therefore needs to be interpreted with some caution regarding changes from one period to the next. On slide 34, here are the solvency ratios, each of which has been covered in a previous chapter. And again, we'll go through these one by one. And on slide 35, here are the profitability ratios. Most have been covered previously, but earnings per share and price earnings ratio have not been to any meaningful degree at least. And again, we'll go through all of these in turn. On slide 36, as this vignette points out, rating agencies have a tough job because they are working for the companies that they are rating. However, potential investors are relying on the rating agencies' reports to provide them with reliable information about the companies they are contemplating an investment in or lending money to. See the discussion on page 743 for more details on this. On slide 37, we'll talk briefly about the quality of earnings. This is very important to market analysts, as noted in the text, especially so in light of the recent scandals on Wall Street and the financial collapse of 2008. Companies that spend more time massaging the accounting data to improve the earnings picture may not be spending enough time on running the core business in such a way that legitimate profits will rise. And that's kind of the issue behind this issue of quality of earnings. Moving to slide 38, alternative accounting methods such as FIFO versus LIFO methods for inventories make comparability between companies more difficult. However, remember from a previous chapter that companies that use LIFO must report the difference in inventories if FIFO had been used instead, and this does help with the comparability aspect. Pro forma income is a way for companies to report what they believe is their sustainable income versus the actual bottom line net income reported in accordance with GAAP. In pro forma, the company eliminates items that, in its opinion, are unusual or non-recurring in nature. And this can make a significant difference, as the text notes on page 702. The SEC has provided guidance to tighten up how companies report pro forma income, but there's still reason for some skepticism on the part of investors and analysts. And on slide 39, improper recognition of revenue is the most common abuse as indicated by the practice known as channel stuffing. This practice involves selling large quantities of product at deep discounts to generate massive sales before period end, and thereby pump up the revenue numbers artificially, since the sales for the next period will most likely decline. The WorldCom case, to change the focus here a little bit, is infamous for the massive capitalization of items that were in fact operating expenses. But again, the purpose was to pump up profits. And moving to slide 40, I don't like the way this slide is worded. I think the text gets into a little bit better explanation in that investors don't decide how the price-earnings ratio is calculated or valued, except in an indirect way. The calculation is straightforward. It's the stock price per share divided by the earnings per share. The point the slide and the text are trying to make is that investors do have influence on the market price of the stock by their attitude toward the company, including its present and projected profitability and growth in their eyes. This influence then affects the numerator of the formula for the PE ratio. Obviously, the higher this ratio is, the more attractive the company looks to potential investors. Moving to slide 41, these companies all have pretty healthy PE ratios, although their earnings per share vary quite a bit. This says something about their stock prices and their attractiveness in the market. Note how much Google stands out there with EPS of 1330 and a price-earnings ratio of 30.8. The others are all bunched a little bit more closely together with each other. And on slide 42, as this vignette shows, more is not always better. The expression TMI may apply here. See page 743 for the explanation of what management should provide. Clear, concise, and what's important to the reader. And a lot of extraneous detail not usually necessary. On slide 43, here's a good exercise for quiz or exam purposes regarding the ability to match these terms with their descriptions. So number one measures the ability of the company to survive over a long period of time, solvency, and so forth. You can go through these at your convenience. And slide 44 continues with 3 more of these. Again, it's good to know these definitions. And moving to slide 45, this is a repeat of a previous slide for refresher purposes as we move into some details on the liquidity, solvency, and profitability ratios. There will be some intra-company, that is within the same company between periods, for example, and intercompany between different companies for same years, as well as industry average comparisons as we move through the various ratios. Now on slide 46, to perform the ratio analysis, we first need the comparative financial statements for the current and previous years. Here's the balance sheet for Chicago Cereal, which is the company example to be used throughout this exercise. Now on slide 47, here are the comparative income statements for the same years, including the average number of shares of stock outstanding and the stock price at year end. Note that these are condensed income statements in that only the summary items are provided. For instance, there is no cost of goods sold section with the details of how the cost of goods sold balance is determined. And on slide 48, here are the statements of cash flows for the same years. The net cash provided by operating activities will be of particular importance in computing ratios, but a few of these other amounts will come into play as well. And on slide 49, again, the liquidity ratios focus on the company's ability to cover its shorter-term obligations and have ready cash available for unexpected events. We'll go over each of these ratios shown above in turn. On slide 50, the current ratio to review is simply current assets divided by current liabilities, with the measure expressed as a number to 2 decimal places. In this case, Chicago Cereal's current ratio is not very good, at 0.67 to 1 and 0.60 to 1, respectively, for those 2 years, indicating that for each dollar of current liabilities, the company has only 67 or 60 cents of assets available to pay down those liabilities. And with that, we'll end this part of the presentation.